QuickBooks Online 2025, the profit and loss report, which sometimes can be called the P&L report, otherwise known as the income statement overview. Get ready and some coffee because we're learning how to save time with QuickBooks Online 2025. Here we are online in our browser searching for that QuickBooks Online test drive, the free sample company file available to everybody. We want that result that has Intuit.com in the URL because Intuit is the owner of QuickBooks. Selecting the United States version of the software and then verifying that we are not a robot. They got to give you a test now. AI can't figure this out because AI is stupid. But I can do it because I'm a human being. And so we're going to say, okay, there we go. And then I'm going to close that tab to the left. It's no longer needed. We're in the sample company file, Craig's Design and Landscaping Services. We're going to go down to the reports on the left-hand side in the standard tab within the favorites, right-clicking and then open a link in a new tab. And then right-clicking on the P&L to open a link in a new tab. That's our normal setup process that we do every time. We're gonna go to that middle tab and close up the hamburger, close the hamburger on it. We're gonna go from 010124 tab 123125. You know, you go to a restaurant and they're so lazy, the service, that they don't even close the hamburger when they give it to you. You got the bun is still open on the plate. I'm paying you over here. At least you can take the time to close up the hamburger. I mean, anyways, we're going to say, let's see this in years. We're going to run this report, run it. Now we've got 2024 and 2025 side by side. Let's go to the tab to the right, close up the hamburger, and then we'll do the range change 010124 tab 123125, selecting the drop down. We're going into the years. Run it to refresh it. We have 2024, 2025 side by side. This time our focus is on the profit and loss report, otherwise known as the income statement. I'll keep this as the default report here and open up another one that we can then play with. Let's go to the first tab over here to do it one more time. Otra vez, por favor, one more time. We're going to open a link in a new tab and then go into the right to pick that one up. And this time I'll close the hamburger. Let's just take a look at it for 2024, because I think that's currently where most of the data still is, although QuickBooks is going to transfer its practice data to 2025. So you want to pick the date range that has the data in it for the practice problems. I'm going to go from 010124 to 123125. We'll keep it on the totals this time and run that report. Okay, so here's what we have on the income statement. Okay, first thing to remember, the income statement is not just any report, it's everybody's favorite report. If the income statement is not one of your favorite QuickBooks reports, there's something wrong with you. You have a problem, okay? I don't mean to be rude or anything. I know everybody's a little sensitive these days, but no, you have a problem. You need to fix it because this is one of the major financial statement reports. It's everybody's favorite reports. The balance sheet, the income statement, are the financial statements. All other reports are typically giving more information about one or multiple line items on one of these two major reports. Now, there is one other report that we typically think of. That's going to be the statement of cash flows, which we will talk about later. But even it can kind of be thought of as something that is constructed from the major two financial statement reports. In other words, if you built the reports in order, you would make the balance sheet, income statement, and then generally construct the statement of cash flows based on that. You might also have a statement of equity, but that's kind of in the balance sheet. Now, also, just quick note, if I go back to the tab on the left-hand side, you'll recall that we have all these other kind of income statements: a profit and loss by customer, profit and loss by month, profit and loss by tag, profit and loss comparison. Most of these reports can be generated, constructed from a normal profit and loss. They're not really new reports. They're just alterations of the report that we are on, and we'll see how to do this shortly in future presentations in a similar way as we already saw how to do some of that functionality in a prior section or course on the balance sheet. So let's go back on over to the profit and loss. Now, the first thing we want to note is the profit and loss, and I'm going to do a little bit of just accounting work here because we want to really understand these reports. So the profit and loss, for terminology's sake, is also the income statement. So if you learned from a book problem perspective you learned in a college textbook or something, you probably didn't call it a profit and loss, you called it an income statement. That in and of itself is important to know, because if you're talking to bookkeepers in accounting world, people that learned from software, they're going to call it a profit and loss report. If you then talk to the CPA firm or auditor, which you're going to need to do if you are on the bookkeeper side of things, meaning you're kind of in the middle, you're talking to the accounting department and to management, and then you also have to talk to the CPA firm or at least the tax preparer. A CPA firm or tax preparer is usually going to be using the lingo of an income statement. So that's noting. We can also change the name of that by customizing it if we want. If we're dealing with a client that prefers the name income statement, we could, of course, change the name to an income statement. Other thing to note, what are we using these financial statements for? At the end of the year for the United States, we have to at least do tax preparation, no matter what type of entity we are. If we're sole proprietorship, partnership, corporation, some type of income statement typically will be required. The profit and loss report is the main report that we need for the income statement because it is the performance report, which we'll talk more about later. Now note, you might say, well, man, why don't I just do the income statement outside of accounting software if I only need like one report? I don't even need the balance sheet. I'm doing all this work on the balance sheet over here, and I don't even need it if I just need it for tax preparation. Well, you do need the balance sheet if you're doing the double entry accounting system, which helps you to not have errors because that's part of the double entry accounting system, the balance sheet. So if you're sole proprietorship, back to the income statement, you're not going to be doing data input into tax software for the entire balance sheet possibly, but you still want to do the bookkeeping with the double entry accounting system, which would include the balance sheet. All right, next thing to note, the profit and loss report has a time frame. It's got a beginning date and an ending date, which might include a month, it might be a year, it might be a quarter, but we have to have the starting point. The report will differ if you change the beginning date. Different than the balance sheet, which is as of a point in time. The report will not differ if you change the date range. So let's just recap that. If I go over to the balance sheet over here, note that I have the year ended. If I just look at this 2025 and I look at that 2001, notice if I change this date to 12/31/25, same day, then there's no change to that ending number right there. So why would I have a range up top? Well, the range is important if I drill down on the report, because then I get to what we might call a GL type report, the transaction detail report, which is a date range. And therefore the range is still kind of important on a balance sheet, but doesn't actually have an impact oftentimes on the balance sheet report itself. Whereas on the income statement, it will have an impact. We see the 4,700. If I change this just to the month of December by going 12/01/25, then of course we get much different. We have nothing. Nothing is there. Much different numbers. If I change this to 11/01/25, then we're going to, still nothing is there. I want to go to, I think the data was in 2024. Let's go from 01/01/24 to 12/31/24. And so that's where our data is at. So let's pick that up. So in any case, we have to change, the beginning date becomes important. So we want to kind of think of the income statement. I would compare it to, say, for example, testing how far you can drive in a day. How would you do that? You're going to start with the odometer that measures miles, and at 0, you're going to drive for as far as you can, like 100 miles in a day, and then you get tired and you sleep and you start the next day. The next day you could start the odometer at 100 miles and then drive another 100 miles and then subtract the 200 miles from the 100 miles to see how far you went in day 2 compared to day 1. Or you can reset the odometer in day 2 to 0 again and count upwards. That second is what we basically do in the profit and loss. All of the accounts are going up in one direction. The revenue accounts going up when we generate revenue, expense accounts going up from the perspective of expenses are going up in order to generate that revenue. And then periodically we refresh the odometer, resetting it, closing it out to the balance sheet. That's how the income statement is related to the balance sheet, so that we can then count the next period from 0. the next month, the next quarter, the next year, whatever that period may be. That's the general idea. All right. So then let's take, now the next thing to note here is if I look at the major accounts on the income statement, we have income, expense. That's mainly the two types of accounts, income and expense accounts. You might note that the double entry accounting system, when expressed not with debits and credits, but with an accounting equation, is assets equal liabilities plus equity. And there are no assets, liabilities, or equity on this income statement. So how in the world is it part of the double entry accounting system? Do we have to do the balance sheet and then just tack on the income statement that doesn't really fit into the double entry accounting system? Well, no, it's part of the double entry accounting system. How? Because if I go to the balance sheet, you'll remember that this is the assets equal liabilities plus equity. Assets, what the company has, liabilities and equity, who has claim to those assets, either a third party like the bank or the owners, whether the owners be a sole proprietorship, partnership, or a corporation, equity representing the ownership. If I rewrite this from the perspective of the owners, I can say assets minus liabilities equals equity, equity then being the book value of the business from the perspective of the owner's share in it. So that equity then is kind of like the bottom line. So if I just look at the equity, that's kind of like the bottom line value, well, hold on a sec, of the business, right? This 20, in this case, it's negative, negative 7,695, right? And so then I can ask, well, that's where we stand. How did we get there? How did we get there? That's where the income statement comes into play. So the income statement is the timing statement that's telling us how we got there. And we can see here that net income is now being included in the equity section. That's us rolling net income basically into the equity section. So over here, you got net income at 131 for January through December. And over here, let's make this as of the end of 2024. So we have the same range so we can see what's happening. So I'll then collapse this again, and then I'll go down here and collapse this here, boom. All right, so now we've got 131.54, and the 131.54 has now been included in here. So basically, everything that happens on the income statement, you can summarize as part of equity, meaning income is going to increase equity because it increases net income, and the expenses are going to decrease net equity because they decrease net income. But we're going to give that detail in the form of an income statement because that's going to give us the performance statement, the major activities that are changing where we will stand at the end of the period. So at the beginning period, the balance sheet shows where we stand. Then we have increases and decreases for sales and expenses, which are going to increase and decrease equity. But I want to report all of those increases and decreases on the profit and loss report to measure the steps forward, the miles driven that we did over a period, month, quarter, year. That's the general idea. All right. So that means that the income statement really only has two kinds of accounts, income and expenses, meaning income is us generating revenue. Expenses are the things that we had to consume in order to generate the revenue, noting that the income statement represents the objective of the business, which is revenue generation. Now, again, you might say, well, no, my objective is to save the planet. I'm like, X, or what is it? SpaceX has an objective of saving the human race, the whole human civilization by putting us on Mars so that like if the world gets hit by an asteroid, we can still survive because and it's like, okay, yeah, but you have to there's got to be a viable way to do that. You have to be profitable to do that. You need the profit motive in order to put people on Mars because the government's too inefficient to do it without a marketplace. They're too stupid. You need the market. You need capitalism, man. And that's why Musk makes money while he puts people on Mars because he's smart. He's smart. Okay, so that's what we need to do. So revenue generation is our objective, and the expenses are the things that we had to consume in order to generate the revenue so that our organization is viable, so we're not wasting a bunch of stuff like government organizations do, so we can actually put someone on Mars or whatever we're trying to do because we're being efficient about it. We're making it like actually work. Okay, so there's only two different kinds of accounts, but we could add sub-accounts along the way that are going to give us a little bit more detail. So the baseline, we could call this like a single step income statement where we just have like income and then we have expenses, the two categories. But we could add more subtotals along the way, such as a cost of goods sold category and so on and so forth. All right, let's open up the income statement and look at this line by line. Remember, and as we do, if I go to this first tab over here and we go down to the sales tab and then into, actually, no, let's go to the transactions and then let's look at the chart of the accounts. So chart of accounts, when we set up new accounts, then that's going to be the ground basis on which we construct the financial statements. Down here, it's in order: assets, liabilities, equity, balance sheet on top of the income statement. Here are our income statement line items here that have the account type of an income statement. And then basically our expenses are going to be below that. Now, also just note, when we're constructing the income statement, it depends on the type of industry that we are in terms of how we're going to set up the income statement, in particular also how we're going to have the bank feeds fit into the income statement, as we'll discuss more when we start to do our practice problem. But in general, on the income statement, you might have to deviate from a complete cash-based system if you're in the type of industry where you have to bill people, right? You got to send out invoices. That means that you're going to recognize the revenue when the invoice comes out, which means you recognize the revenue before you actually receive the cash, which makes sense from a performance statement or standpoint, because that's when you actually did the work. So you should recognize the revenue when you did the work, is the general idea. Now, a couple things on the income statement. We do not want to set up too many income accounts because it's too much detail typically on the income statement. So two errors that we want to be careful of. One, we don't want to set up a separate income account for every customer usually, because that means we're going to have a whole bunch of income accounts by customer. That's going to be somewhat tedious, too long, too cumbersome on the income statement, number one. And number two, hopefully, if we use the proper forms and add customers, like the invoice form and sales receipt form, as opposed to the deposit form, then we should be able to generate a subledger report that's going to tie out to total income broken out by customer. So I can get the more detail in another report, and therefore I don't want it on the profit and loss because it'll be too tedious. However, there are exceptions. If you're in a very simple system and you're building your income statement by the bank feeds, maybe you're just a gig worker, all right? I'm not like putting you down. I basically a gig worker, right? But I mean, like, it's a simple accounting process, right? If you get paid by like Google or platforms or something, then you're just going to wait till it clears the bank and record the deposit as income. In which case, you're not going to record the customers most likely, and you're getting paid by the platform. So therefore you might set up your income accounts called whatever the platform income, basically by customer. But that's the exception to the rule, right? If I was a landscaper or something like that, or I sold inventory, I'm not going to make another income account for each customer I sell to. The other thing that we want to be careful of is not making a separate income account for every thing that we sell, every inventory item or service item, because once again, it'll get really tedious. You'll end up with this long income statement. And normally, if you use sales forms and invoices, you should be able to get that added detail by running subledger accounts, tying out to the income, but breaking out by the things that you're selling or services that you're selling, inventory and service items. So this income statement actually has more income accounts than you would expect from most businesses, because the type of industry it has, being a job cost kind of system, basically landscaping, So just keep that in mind. You possibly have more income accounts here than you would generally have in most type of businesses where you might just have one income account, even though the income line item hopefully will have a bigger dollar amount than the expense line items. It's usually a lot cleaner, or one line item versus multiple line items, for example. All right, so that's going to be the income statement. The income statement's going to go up, as we can see when we enter income forms. That's going to be the invoices if you have to deal with accounts receivable, or if not, the sales receipts if you're at a cash register, and if you have a very simple system and you're using the bank feeds to record it, you will have the deposit forms increasing the income. So they're going up, and then we have down here on the expense side of things. So I'm going to collapse all of the little triangles under the expenses. So then we have the expenses. Now the expenses are the things that we consumed in order to generate revenue. Noting that when cash goes out of the business, or when you buy something, which typically means cash is going out of the business, the other side is usually an expense, and therefore the expense forms are the thing that we can generate most readily oftentimes with the bank feeds, because every time we pay for something, we can determine by who the vendor is that what we paid for, which is usually like the telephone bill, the utility bill, and so on and so forth, and we can assign those to an expense as we pay for them. So that's the main thing you're often going to do when you set up a new company file and you're excited about possibly setting up the bank feeds. The bank feeds are going to track all of the outflows, noting that when you think about the checking account, which is the lifeblood of the company, there's going to be a higher number of transactions that have outflows than inflows. However, we're hoping that the inflows, revenue that comes from the revenue cycle, is greater in dollar amount than the outflows that are happening, right? So that's why on the expense side of things, you're going to have a whole lot more categories. The other way you can think about it on the income statement, this is usually where you have the most detail. Why? Because on the income side of things, we only do one thing. We might just sell one thing. But we're hoping we generate a lot of revenue from selling that one thing. We are specializing in the one thing. Everything else we're not specializing in, we are paying for, and therefore there's going to be a category for everything we need in order to support that one thing that we're doing to generate revenue. So that's why there's going to be all these different categories on the expense side of things. You have a similar kind of thing to be careful of with the expense side of things, that being you don't want to set up your expense accounts by who you paid. So you don't want to set up an expense account that says Verizon expense or AT&T expense or Edison expense. Those are the vendors. Those are the people that you paid. What you want to do instead is translate, usually through the bank feeds, by vendor what you paid for, and then put the expense account based on that, which will be telephone expense, utility expense, and so on and so forth. Now, note that the expense side of things also usually has the biggest range of how you want to set it up. Meaning, some accounts you can think of as basically standardized between businesses, like the telephone it is what it is. The telephone, the utility is usually the same. But your business might have expenses that you pay for that are different than other businesses because of the industry you're in. Like famously, from a tax perspective, if you're like in an industry that somewhat sounds fun to an IRS auditor, then they're going to be more skeptical about those industries, right? So like if you're a filmmaker and you're researching by going to the movies, maybe that would be a legitimate expense for the movie ticket. But if I was an IRS auditor, I'd possibly be like, well, that doesn't sound right. You know, you're expensing a movie ticket. What? Or if you're a photographer and you went to Hawaii or something like that, and you're kicking it on a paddleboard, you know, filming things and then calling it an expense. Again, possibly that's legit if you are a photographer, but from the standpoint of an IRS auditor that's supposed to be sitting in the IRS office, they're not really these days, because the government got crazy. So a lot of the government are sitting at home doing nothing. So they're probably in Hawaii too, just doing nothing. But they're cracking down on it now. So they're cracking down on the government workers. And if they actually had to do work, then they would be like in the office doing work, and they would be jealous of someone who has a job of taking pictures, right? So you get the idea. So you might have different expense accounts. So you want to set those up basically as you go. All right. So then on the expense accounts, if I go into one of these, for example, then you can see that they're being created either with a bill form or a check form or an expense form. The check form and expense forms are the forms that decrease the checking account. The bill form is the form that you would use if you're entering the bill but not yet paying for it. It's an accrual form, the one that's going to increase the account's payable account that you will then have to pay off at a later time. All right, so the expenses that we have here, notice we have the collapsible expense column, and then we also have in there these other collapsible areas. Where do these come from? These are what we call sub-accounts. So you're probably going to have more capacity for sub-accounts in here than any other location on the financial statements. The sub-accounts is going to be QuickBooks' major way of being able to customize the financial statements. Now note that you could order your expense accounts by, say, by account number. You can add account numbers. But a lot of people don't like doing that because they're not really good at organizing the account numbers. So they just don't do account numbers, which is the default setting within QuickBooks, which is fine. But then within each category, the expense category being the longest, it's going to organize your accounts in alphabetical order, which might not be the way you would ideally want it. So then the next thing is, well, how can I organize my accounts in more of an order that I want to without account numbers? One way is with the use of the sub accounts. So for example, if you have the automobile, you might have multiple things that you pay for the automobile, like new tires or just maintenance, fuel, insurance. You might put all of those things into one account called automobile expenses. However, it might be useful, you might like to break them out so you can break out the detail of the fuel versus so on and so forth, right? So how can you do that? You can make a parent account called automobile, which oftentimes you wouldn't post anything to, and then add all the sub accounts that you're going to be posting to. Notice what that does. It adds a lot more line items on the financial statement because one, you're adding more accounts instead of just using one account. So the question is it worthwhile for me to have 3 accounts for automobile, fuel, maintenance, insurance, for example, versus one account, which would be, easier in some ways, although less detail. And then if I put them into a sub account, I add 2 more columns, right? Or rows. I have a row here or here, and I have a total here. So these sub accounts allow I could collapse the sub accounts and then give a financial statement that has the collapsed sub accounts and then expand them and give them more detail. That's the cool thing about sub accounts. And you have a collapse function up top. So I can collapse them. That cleans up the financials, possibly for external reporting or less detailed reports. And then I can expand them, giving me more detail in those. But it also adds a lot more information. So some people go way too far with too many accounts because they like the detail. Other people go way too far in too few accounts because they don't like the detail, right? So that's where the play is on the income statement. And then at the bottom of the income statement, we have the other expenses. Down here, you could have other income and other expenses because you might have things that aren't part of your normal operations. So you might have, for example, interest is one thing that sometimes is put down here. Miscellaneous, I don't think is actually proper down here, but you could like miscellaneous, like interest. Interest expense is only there because you had a loan taken out. So maybe it would be appropriate to put that interest expense in the body up here as a normal business expense, but it's not really part of the business. It's part of financing the business. So you could make an argument that you should put the expense down here possibly. Or if you sell stocks and bonds and you had a gain on the stock and bond sale, but your business is not in the business of selling, it's not a financial business, you just happen to have some stocks and bonds, then that's not an expense that you expect to have happen all the time, and therefore you might put it down here. That could be useful because what you want to get is to the net operating income from operations, because that's your operating income. And the things that you don't expect to be repeating, that's when you would have it down here, like a gain on a sale of stocks. If I don't sell stocks all the time, I'm going to put it down here and say, yeah, I had this gain, but it's not going to happen next year because that's not my normal business. This is the performance that I expect to be repetitory, or the thing that I want to compare performance-wise from period to period. Now, we also could have the same thing on the income side of things down here, and then you get to net income down below. I also noticed that we had the cost of goods sold in here somewhere. This was income, total income. They don't have the cost of goods sold. Let me go back. Let me go to 2025. 01/01/25, 12/31/25. Is there any cost of goods sold? There it is. So here's cost of goods sold. Cost of goods sold represents inventory that we're selling. And you would only have cost of goods sold if you sell inventory. So we'll get into that more as we go. So let me just kind of give a summary of this. If I was to collapse the major categories, if all I had was income and expenses, we could call that a single step income statement. Sometimes they call it that in textbooks. That's the easiest income statement. Or I could add more subtotals like cost of goods sold. Cost of goods sold is an expense, but it's often the most important expense if I sell inventory. If I sell inventory, the cost of the inventory is usually the biggest expense. Therefore, I'm going to break out a special subcategorization just related to the cost of goods sold. So it's just kind of like a pit stop along the road to the bottom line of net income. So in this case, it's at the 3959.8 minus the 405. That gets us to the 3554.80. And then all of the other expenses, the normal category minus 1780.8, that's going to give us our 1774. And then if there was any other income and expenses, I would add them as another subcategory to get us down to the net income. So notice that if we have any of these subcategories, these subcalculations, it's always going the same way. The income is what we generated. Everything underneath it are the things that we consumed in order to generate the income. Therefore, they're going to decrease the income. One more thing to point out on these expenses. Notice that usually if cash goes out of the business, it's because you're paying for something in order to help you generate revenue in the current time period. But sometimes you're paying for something that's going to help you generate revenue into the future. And that means that's why you'd put it on the books as an asset as opposed to an expense from an accrual standpoint, noting you can't get away from accrualness sometimes, meaning if you paid $100,000 for a building, even if you're on a cash-based system, you're going to have to do the accrual thing, putting it on the books as an asset, at least if you're in the United States, because the IRS is going to force you to do that. If you didn't do that, what would happen? You'd have this giant expense on the books for a building that you're going to be using for 30 years. So see how that doesn't make sense from an accrual, from a comparative standpoint. If I had like January, the month of January, I had a $100,000 expense for this building that I bought, and then in February, I'm not going to include the building expense. It's going to look like I had a horrible month in January compared to February, because I'm going to have this huge loss in January and not in February, but I used the building in February, even though I bought it in January. It's just that, I paid for it in January, and that's what the accrual thing is doing. So anytime you have a larger expense that you're purchasing, we have to think about, should I record it to an expense account, or does it need to go on the books as an asset, typically under property, plant, and equipment? All right, so that's the general idea with the income statement, the performance statement, the profit and loss, sometimes called the P&L.